Hello, once again, ladies and gentlemen. Welcome to our next session of the day. I don't know about you, I am loving these discussions that we're having so far this morning, and I'm sure this next one is going to be even better. So the next panel today is called Stemming the Tide, Liquidity in the Era of Meme Stocks, and we all know what that means. Robinhood has already been a big topic of discussion today. We are just a few months off from the GME debacle that happened earlier this summer. So, of course, with the rise of trading apps and the surge of retail investors, questions about changes in market structures, keep making headlines. So we have an absolutely star-studded group of panelists here today to discuss this. I'll just introduce them briefly. We have our moderator, Hormoz Faryar, the head of institutional sales at ADSS, Peter Plester, the head of FX Prime Brokerage at Saxo Bank, Andy Biggs, the head of liquidity at Finalto, Ian Daniels, head of iFX distribution in the EMEA region for Nomura, and Natallia Hunik, the chief revenue officer of Advanced Markets Group. Let's give them a warm welcome. Thank you, everyone.
Great. Welcome to the liquidity panel. My name is Hormoz. As mentioned, I work for ADSS, which is a retail broker out of Abu Dhabi. And we have a big institutional element to it as well. So we're a bit unique because we're based in Middle East. So today we're going to talk about liquidity. And we have a great group of panelists, extremely experienced. I know all of them. If they don't know it within this space, it's not worth knowing, right? Between them, they can answer everything. So I've prepared some questions. Should we quickly introduce your companies, very briefly?
Sure, yeah. I'll start. Okay. Natallia Hunik, Chief Revenue Officer at Advanced Markets Group. Advanced Markets is a prime of prime and institutional liquidity provider, licensed in the UK with the FCA as well as in Australia. We're providing liquidity to institutional market players like hedge funds, proprietary trading groups, family offices, regional banks, as well as we're distributing our liquidity to broker dealers here in Cyprus and elsewhere in the world.
You're based in the US, right?
I'm based in Boston, yes.
Ian Daniels, I'm head of iFX distribution for EMEA in Americas, based in London. I work for Nomura. Nomura, if you don't know, global financial services group, headquartered in Japan, present in 30 or so countries. Our goal really is to connect markets east and west.
Hi, I'm Andy Biggs. I work at Finalto as the head of liquidity for the group. Finalto is a wide-ranging group that offers B2B, B2C, and technology across the sort of trading ecosystem.
Hello. Peter Plester. I work for Saxo Bank, which hopefully most of you will know we've been going for 28 years. We are a multi-asset broker. We have a large retail franchise and a large prime of prime and institutional offering. So many of our biggest competitors are also some of our biggest clients. I think we offer about 40,000 different instruments across many different asset classes, and a lot of the brokers here in Cyprus are our clients for the FX and liquidity. So.
Great, thank you. I just wanted to start quickly with a summary of 2021 and the liquidity events and what happened during the year. Perhaps we can start with you, Andy. What happened volatility-wise and what's been going on this year?
Sure. I guess in the FX space, not a lot is probably the answer this year. It's been pretty quiet in terms of volatility. If you look at it in sort of seasonally for the last 5 years, it's close to all-time lows. On the opposite end of the spectrum, you've got single stocks, the meme stocks, the GMEs, which have been pretty incredible to watch. I think that was in January, followed up in April by Dogecoin and the sort of altcoins of crypto. And then somewhere in the middle, which is probably more where we sit, precious metals and indices, where we've seen a bit of volatility and a lot more trading. We've seen trading really focus on that precious metal and index space as opposed to the FX that we know and love from the past.
Right. And Pete?
Yep, so by far the biggest change in the past year has been the the rise of the investors and the switch from trading FX and some derivatives to cash products. So cash equities, there's an awful lot of small investors out there outside of the US where I think this is very prevalent. Everyone looks at their 401k account and has an account at Charles Schwab, etc., Ameritrade. In Europe and Asia, a lot more people are now taking charge of their own investing decisions using mobile apps, making regular payments into their accounts, and actually taking a huge interest in what's happening in the markets. And I think this is part of what's happened in the meme phenomenon. And it's basically the switch over the past year has been from the low volatility in FX to the high volatility in, as was said, in stocks, etc. And people are just switching over and focusing much more on stocks.
And Ian, how about
unfortunately,
maybe something in Japan?
Well, no, unfortunately for me and our team, we look after FX, so it's been a pretty difficult year. As you said, as Andy alluded to, nothing really much going on. Post-pandemic, all-time vol lows. A slight pop-up in the past couple of weeks with some US dollar action, but it's generally been difficult. If you look at I think it's the Greenwich survey recently showed global fixed income, commodity and currency revenues down about 40% from last year, albeit from highs in last year, but still it's that shows across the board banks suffering when it comes to the FX piece. So yeah, all in all, from that perspective, it's been a difficult year. Talking to our clients and on the ground, it's that move from FX into more high vol products that's happened. So unfortunately, we personally can't participate in that where I sit, but it's certainly moved in that direction.
You wish you could do a bit of Bitcoin, I guess.
Exactly,
huh? Exactly. But so was it worse than? So this year was worse than 2020, but was it worse than 2019 and 18 as well? Then that bad?
Much worse than 2020. Probably, yeah. Yeah, I think worse than 2019, 2018. It's going back quite far, and it's certainly been a challenging year.
Natallia?
Okay, I think I second everyone already said about the low vol
and
effect.
You were going to disagree and say no.
I wish I could, but the numbers speak for itself. And before the panel, I asked the desk to send me the G7 Deutsche Bank Volatility Index, and you can see it's down from like 12 to about 4 this month. So, clearly, the market's not moving in FX. I mean, driven obviously by the underlying forces like no change in interest rates. And of course, investors are looking for return. And, therefore, we see the surge in trading of crypto and the single stocks. And I think the guys already mentioned that. So in summary, yes, it's a tough year coming out from 2020 when, volatility has been great. Coming in 2021, it looks completely different.
Yeah. Anything to add? You guys think it's going to be better next year, maybe, or?
I think Peter alluded to it, the kind of Americanization of the European trading and that move towards single stocks and indices is something I think we'll see translated through social media from the US. And I suspect we'll see more of our clients demanding more products, more single stocks, and especially move into cash equities as well.
I think bonds as well will be the thing to watch in the next year. So as long-term interest rates start to adjust, the bond markets are enormous and very liquid, and again, not really utilised very much in Europe as a trading instrument. And there's a huge wide range of bonds available across geographies, industries, risk, etc. So I think bonds will be the big thing for next year.
That's interesting. You think bonds can ever kind of come into the mainstream, almost retail, high net worth side of things electronically?
I think so, yeah.
So people can invest in...
Yeah.
Okay. Let's delve into a bit of liquidity management and liquidity side. So I just wanted to, just one of you guys maybe, or all of you, explain a little bit about the payment for order flow and what the issue is and how it works. How does it work? People pay... Just for the audience, explain, do people pay for order flow? What does it mean? Any of you do it? Or any of you know about it?
Whoever speaks first.
Yeah, you do it. Go for it.
It's a practice that was, it's not a new practice to the industry in general, but it was turbocharged by Robinhood, obviously, with offering it commission free. It's in the US, at least, it's completely legal. However, you need to make sure that the client is served with the best price. And the way you reference that is you check against the national best bid, best offer system. I guess why it's questionable practice is because Robinhood was fined for it for two reasons. I think it's like $65 million fine. Number one, they were not disclosing that they're doing it. While it's legal, it's okay, but they were not telling the clients that that's what they're doing. So they were sending the flow, and one of their partners, one of the hedge funds.
Or is it well known who it was that they were sending it?
It was
public,
it was not public until I think they put it in their S1 file, and that was one of the hedge funds, and they mentioned the hedge fund, and they also mentioned the numbers, right? So about 75% of their revenue comes from payment for order flow. So they send the orders to preferred liquidity partners, and liquidity partner gives the client requests a price, they give the client the price that the client requested, and then they send the order to the hedge fund, and the hedge fund is able to get a better price, better execution price, and share the revenue with the broker. Essentially, that's how the model works. I guess it's been questioned in the US as well, and the guys can speak to the UK, and I know Australia is also looking into it. While there's nothing, wrong with it, fundamentally, you still have, obviously, a little bit of a conflict of interest because, you send the flow to a preferred partner, right? Which, how do you determine that preferred partner? Is the partner giving the client really a best price, or is it just a good price?
I thought you have to prove that it's the best price, but then you choose.
It's a very convoluted market in the US, so yeah, you could prove it, but it's very difficult given the size of the market and the number of orders that goes through, and it's difficult to prove.
Okay.
But it should be the best, not just the good.
Pete, anything to add?
Well, obviously, everyone has obligations for best execution, etc. And in life, very few things are free. Even though you go to the Bureau de Change and they say commission-free foreign exchange, but you look at the spread and it's 3 miles wide. So it's not actually free.
I got this pen for free from Andy.
You'll be paying for that later.
He'll be asking for something.
Yeah, we'll be coming back to find you later.
He's got the contracts in his bag. So nothing's free. So at Saxo, we don't do payment for order flow. What we do is connect clients directly to the exchanges, to the source of the liquidity, but we also have smart order routing. So if there is a better price available elsewhere off exchange, we will improve the price for the client. But we don't get paid for that. That's sort of an additional service. But as a client, I would rather know exactly what I'm paying, what it costs, rather than I'm transacting a trade, the price is built into the price, but I don't actually know how much the fee is, etc., etc. And I don't think that bodes well for best execution. So,
but it feels like it's been taken too far. Like it's, if you go to the supermarket, do you want to know exactly how much their revenues are, how much profits they make, where they're buying things from? It's gone a little bit too far, it feels like. People demand to know everything. What am I paying for? Where is the commissions? How much profits are you making? Isn't it too much?
But my weekly shopping is around £100, whereas if you're doing trades of hundreds of millions of dollars every week, these things make a big difference. And you have clients who you're transacting on behalf of, so you have a responsibility to them to make sure that they're getting the best price and that they're being charged appropriately, etc. And by having this sort of murky behind the curtain deal going on where no one actually knows what they're paying, I think is not a good thing.
Yeah. Ian, anything on the pay for order flow?
Not really something that we participate in or would do, and it feels alien to me even being talked about. But I think in the FX world, as an example, the prices on the bid offer spread can differ at any point in time at any place with different people who may have different skew in their price, and it's different to OTC pricing is different to exchange pricing. So I think the payment for order flow in FX it becomes even more murky in my opinion in terms of how do you prove it's best execution you're getting, how do you prove you're getting the best service if you're giving it all to one guy, what are they doing with it, are they making X off it and giving you Y? how do you know, and how's it proved, and should you ever sort of have just one provider? Not sure if that's the right thing.
Yeah, for example, if you guys want to capture more dollar-yen flow from a broker like us, you could do stuff to capture that flow. So essentially, that's a way of paying for order flow.
To a degree, but
skew.
Yeah, it's skewing, but it's part of your inventory, so it suits your book, right? So it's good for one party because you're getting effectively best execution, and it's good for us because you're taking us out of risk. But there's no, it's not like we're actually giving you some money in a brown envelope for it,
And there's also, sorry.
Go on. I think on the FX side, when dealing with banks, non-banks, any sort of payment for order flow becomes a zero-sum game. Any payment you would receive is just going to be reflected in the spreads. And so for most people, I would say you'd much rather have the better spreads, have the transparency of transacting on what you feel is the best price, as opposed to having some sort of implicit cost you don't necessarily see. And then on the equities side, I think it's such a huge topic, and it's so difficult to in such a short time get to the heart of it. But effectively, it's not. I mean, my argument is it's not really fair for a retail trader to get the same price that a stat arb desk gets when they're trading on exchange. So retail traders should get a better experience. And the question is how do you transparently provide that better experience? I'm not sure the industry has fully answered that yet.
There's also a credit risk as well. So, I mean, there's been a couple of brokers over the past few years who have actually gone belly up because they haven't been paid the revenue shares that they've been, they should have received. And if you look back at things like Fortress Prime a few years ago, if you're sending a huge amount of flow to someone and you're expecting to get paid for that, and eventually they don't come up with the money, your business could be at risk because you've not actually, you might have to pay something back to your clients, or you've improved the spreads, or et cetera, and the revenue disappears, and effectively you could go out of business.
Yeah, it's interesting, Peter, that you bring it up because we make such a big deal of Robinhood, but I mean we all know that this type of practice is everywhere in FX.
So would you classify any kind of profit sharing deal as?
Essentially, that's what it is.
Payment for order flow.
Pretty much, which is something that's going on, everywhere.
I think would you also say that the credit risk there that you mentioned, Pete, a broker going bankrupt, that impacts your funds with them. So that's not exactly the same thing as your, the profits from your trading being at risk. Different kind of risk, right? It's kind of default risk there. That's
it's a counterparty risk, which you have to.
I guess everything's into, meshed into each other's.
It just seems much easier to give a client an improved spread rather than all this sort of murky back and forth, almost brown envelope sort of thing going on. If you give your client the best possible spread for that particular client relating to their flow, the amount of business they do, etc., then everyone, it works very efficiently.
But to give someone good spread, don't you have to take some risk and take a risk that you guys do that, right? You take risk to be able to create good spread. Otherwise,
well, that's what it is to be a market maker, isn't it? So, yeah.
I mean, at the end of the day, when someone trades, someone else is taking the other side of it, and so the market makers are taking risk.
Yeah, but if the market makers are being hammered and they've been told, look, you can't do this and that, and you have to treat every client. There's some crazy ideas out there, right? Treat every single client the same way, give everyone the same price. There were some ideas, put everything on exchange. It feels like it's pretty tough to be a market maker in a currency. So I wonder, it looks like that's going to be, for you guys, for example, must be tough, right? As a bank, you need to be there for your clients. Everyone expects you to market make big amount of FX flow.
Yeah, I mean, you have to be there, but you've got to price risk appropriately. Like I've always said, there's a price for every client, right? And you've got to be able to price that risk in appropriately to what you see. So if a voice trader, if a client asks a price, a voice trader would hear it, would hear the request and know from previous experience where they think the market's going to go. When that client asks a price, they might ask $50 yen. They know that actually that's not 50, that's 200. So they know that they need to, give a price that suits their book, but also accounts for the fact that this client doesn't trade in full size. So you kind of have to have those knowledge of the client and knowledge of how their previous trading. Doesn't mean it's going to happen again, because past performance isn't a guarantee of the future, of course. But that's the kind of thing you're obviously doing when you're market making. So yeah, it's difficult, but I think it's about knowing your client base and adjusting yourself accordingly.
That takes me to another thing. The word last look. So someone was asking, explain last look again. Many people have heard about it, but for those of you who haven't heard what last look is, who would like to explain what last look is in the FX liquidity scene and why it can be good or bad? Who does a lot of last looks here? They look at each other.
Well, effectively, it's a check back on to check that so say you're trading at X time, it's a check back to ensure that the price is the same as it was when you clicked, right? That's effectively what it is. So it's a last look on the price that you traded on, but also it's kind of it means different things to different people. So within that last look period, you are doing a credit check and the price check, and sometimes an additional checks that people have. Now, because every time someone's trading with you OTC, then we're having to do a credit check on that to make sure that there is ample credit for that deal. So that obviously takes time. Depends on your system. Might take milliseconds, might take 10 milliseconds, whatever. So there's always that, because you don't want to be exposed from a credit perspective. There's that, along with the price check, should we say, and that's all encompassed in one last look check.
It feels like so if you're the client and you're buying something, it feels like the seller, which is the liquidity provider, has the last look. He can say no. After you've said, yes, I want to trade at this price, they've said, yes, this is our price, you say yes, the liquidity provider can say, nope, I don't want this anymore. And that feels like, the client should be able to do that too and say, you said, yes, I want to do it, actually, I don't want to do it.
Well, it depends. You should have symmetrical price checks, right? So it might go in your favour or the client's favour. But if you have a symmetrical price check, then you know that regardless of which way it's gone, then the deal's rejected because the price has moved X amount. You may have a tolerance that says, okay, if it's moved a tiny bit, then let's accept it. But if it's moved X amount, then it's effectively an opportunity cost for either of you, and it's better that that person trades with the next person who has their price, for example.
I don't think it's a bad thing. So last look is very similar to, I used to be a spot trader at banks for 20 years, and someone would ask you a price, and you might quote the price, and you hear the price change in the brokers, and you quickly hit the cancel button on Reuters, and it'll bring the price back, and you quote a new price. Or the same thing would happen in the voice brokers. So it's a similar thing. If you're providing this risk transfer service to clients, and it's a very important service, that keeps the market going, oils the market, and makes sure that everything works properly, then it needs to work both for the market maker and for the client. And as long as it's not being abused, then I don't think there's a problem with it. And what you find now is, over the past 3 or 4 years, the actual last look period that has become sort of acceptable has shrunk massively. So we have some LPs.
Is there a rule on that? Or acceptable, meaning
I think it's one of these sort of self-regulation things. It's what clients are willing to accept.
Yeah.
And
how now
much is that?
we have some LPs that will respond in less than sort of 10 milliseconds or whatever. It's very, very fast. So it's effectively they have the right to say, no, you've missed it, but because you get that no so fast, you're not disadvantaged and you get the opportunity to go elsewhere. And it's literally because the market would have moved. So
I think with last look, there's lots of different types. So the one, if you go back 10 years where someone was holding on for half a second, just checking if the price got better or worse and rejecting is horrendous. And I think we're past that now to a stage where last look is genuinely there as a defense mechanism. And if you look why last look is bad, it's because potentially you could send an order and get rejected. You then have to retry at a different price, and there could be an effective cost to that. But I think over time, if you have a team that manages the last look, manages the rejections, what you find is for retail flow, it is significantly cheaper over time to have a last look and have much tighter spreads than to have no last look whatsoever, have wider spreads for all of your trading generally. You can also still miss a price with no last look. And then I guess the final point on that is most providers should be able to offer both. So you should be able to see both and figure out which one works for you and for your trading style.
Okay, makes sense. Takes us to another word in the jargon of liquidity management, which is you guys always talk about markout and markout charts. Can you guys explain that? Is it just a way to measure profitability or chances of making money or type of flow or mismatching each flow? What is that markout? The basic definition of it.
Well, I think firstly, the first point, I think Andy will be much better explain this than I will, but I think the first point is measuring profitability. But if you think about it, and this was alluded to on the panel before, and it's an interesting game, but market makers are here to make money. If you didn't, then you wouldn't be there, right? And if you're a bank, you're there to make profits for your shareholders. It's not about, you're not in the business of losing money. So you need to know, again, we talked about this, the example I used before and the example that Peter used around price changes, etc. So we're talking about how clients trade with you, because a lot of people are trying to make money out of you, basically, and that's their raison d'etre, is to kind of try and game you as a market maker. So it's a game of chess, really. So I think the mark-out profiles and how they're worked out is a way of effectively seeing how, over time, the trading activity of XYZ client has been, and then you can adjust yourself going forward.
Again, going back to the sort of the good old days on the spot desk, it's the idea. Merrill Lynch London would call you up, dollar yen in 10, and you know that 99 times out of 100, that deal is going to go horrendously wrong. They'll hit you and the price will suddenly go completely against you. And you don't want that. If you're streaming electronically a relationship price two-way, you're providing a service, you want to make sure that, again, you're somehow protected and that it's a fair, equitable relationship and that you're both making money. So the mark-out will give you a good idea of actually what happens when that client trades with you against the mid-price of the market. Does it suddenly just go straight against you, or do you get 30 seconds, 60 seconds, 2 minutes, etc., to try and internalize and trade out of that position? Because you've got these LPs that are quoting two-way prices to thousands of clients, and what they want to do is obviously get given on the bid and then skew their price slightly and get paid on the offer and just make a spread and internalize it. And having an idea of what the mark-out value is of the flow of the client that you're trading gives you a better idea of how to actually monetize that, what sort of spread you should provide, and what to expect. So it's a good thing.
Yeah. Andy, would you say it's more of a, well, people use it to measure how good the client is, or if someone's trying to game you, but is it also that the client can check if the liquidity provider is gaming you, or kind of like, is it a two-way thing, or you have more tech than your clients, so you can see if they're gaming you better than they can see what's going on? Or
any part of being a broker is having to manage both sides. So I think markouts enable you to manage both sides. So things like latency arbitrage come out very, very clearly on markout charts. So markout charts are aggregations of hundreds, thousands of trades. So they give a pretty good signal of what the flow looks like over time. And equally, you can see, okay, I've added a new liquidity provider in. We expect our liquidity providers to hold risk and to not exit the trades immediately and cause a heavy market impact. This is better for our clients. It's better for the other LPs that are in the pool. So we're monitoring both. We're monitoring if LPs change the way that they hedge our flow, and also what clients' flow looks like. And ultimately, a markout curve is the value of the flow, is the profitability. And you can really accurately predict if the markouts are negative, then to make the flow profitable, you have to widen spreads. So
and conversely, of course, if the flow looks really good, then the client can actually benefit from the fact that they do have really good-looking flow. So it's not all negative.
quite scientific from what I understand as well. And there's a lot of platforms and tech companies now specializing in just this subject. It's quite amazing.
And I think just to add on your point about two-way, it's certainly enabled a lot better dialogue and less of sort of he said, she said type dialogue, more around, this is evidence of great flow. And then as a client, they can come to liquidity providers and say, look, we've got this third-party provider who's given us our markouts with all of our banks or LPs, and we're really good. You should be giving us better pricing, and then they'll go. We'll go along, and actually, yeah, it's a good point. So it's a two-way dialogue, and we've noticed a sort of waterfall. This was what we were having with our clients. We've noticed that our clients, people like these guys and here, will then have with the retail brokers of their own, right? So it's kind of like, it feels like from my perspective, I think it can only be a good thing to make it a better experience for everyone.
And what we found as well is that markouts can look negative, but there can be so many different reasons for it. And you can have dialogues with clients and maybe change trading style. They get a better price overall, and ultimately the liquidity providers make money. So it does enable these really good conversations.
Yeah, I've even heard cases where the client has bad flow, let's call it, and then they change nothing except they remove one of their liquidity providers, and the whole thing looks better. So it's quite complicated.
Exactly. I was just going to add to what the panel already said, that the tools become more accessible, and it certainly makes it easier for both sides to manage the flow. And it's no secret, especially in FX, there's a lot of recyclers, and it just helps you to utilize your internal resources better, all these analytical tools. And I think right now, even on the retail side of things, there's more accessibility to this markout reports, which helps them to run their business more efficiently.
Okay, let's move on to gold. There was some events in gold a few weeks ago where things moved quickly, and I think there was a lot of widening of spreads, I think, right? And is there overreactions? What's going on in the gold segment? Gold is slightly different than FX?
Gold is a weird one. So when I was at Rabobank, we PB'd FX, but we couldn't PB gold, because you needed a different settlement system. You needed basically an access to a vault. So with normal currencies, they're effectively the numbers in computers and, numbers at central banks, etc. But with gold, it's a physical lump of metal that needs to be sat somewhere and stored, and it's worth a lot of money, so it needs to be locked away in a very safe vault. And that costs money. There's a lot of complicated provisions that need to be made for that. So some banks will treat gold as a currency, and some banks will treat it, or LPs will treat it as a commodity, FX or commodity. And the credit we tend to find as well for precious metals, so it's gold, silver, platinum and palladium, is different as well. So when we strike up a four-way, or we do a designation notice with an LP with our BBs, you'll get the credit line for the normal FX, and then there'll be a separate side letter for the precious metals, or not. So some LPs, non-bank LPs, for example, won't be able to trade precious metals and quote you in those. And
so is there less liquidity providers in gold?
There are,
then,
yeah, definitely, yeah. And some of the banks actually don't provide pricing in precious metals either.
So when the volatility kicks in, gold, is it understandable, or is it an overreaction that the gold price becomes so extremely wide? The price...
I think it's one of those things where you have to really choose your LPs, rather than having 30 different LPs like you could in FX, where euro-dollar is very commoditized. Where in precious metals, especially gold, if you have a really good LP and a really good relationship with your LP, and you send them good flow, etc., and you do lots of two-way communication, it really is worth its weight in gold, shall we say, having that relationship where you can end up getting a good price. So,
going back to markouts in gold, there's very few gold providers that will take on risk, and if you overpopulate with gold providers, you'll end up in quite a bad way. And the problem is, the providers who are externalizing it immediately tend to have slightly better prices over big volatile events. So they can seem to be quite a good idea during volatile events, but then during normal trading, you'll find a deterioration in prices overall. So it's a tough one, gold. And I think it gets lumped in with currencies a lot. And 2020 was a great example where the basis blew out between futures and spot, where you realize actually there's a physical thing underlying it that gets shipped and flown around the world. And so helping clients understand the differences and just the size of the markets as well, and the ability, you know, 100 million euro-dollar trade is easily absorbed. 100 million gold trade is humongous. And trying to A, manage the liquidity for that, and B, manage the client's expectations of what they can get is an ongoing difficult one.
Yeah, they say if everyone wanted to get their golds, electronic gold, physically, there isn't enough gold, right? The price would have to go up a lot for the physical.
I think people will be pulling their teeth out, literally, trying to...
gold teeth.
Yeah.
Do you guys...
Yeah, so what happened, and the one that you reference is, I think the U.S. jobs data came in on Friday, and it was better than expected, and so the market reacted on Sunday. U.S. Sunday open during the Asia hours, which generally have thinner liquidity in FX as well, but especially in gold, and the price dropped to like 1700 level and triggered a bunch of stop losses, and that created a snowball effect. I mean, something that we kind of witness in FX almost on an annual basis, like AKA the flash crash, right? When the algos kick in and the liquidity evaporates. And yes, it's difficult. And I think Peter and Andrew already spoke to that it's difficult to get liquidity in gold. A lot of banks, started offering gold, spot gold, I mean, in the last like 5-6 years. Generally when you witness a thin liquidity event like that, obviously, it impacts the gold to a larger extent than it would, the currency, the more liquid currency pairs. With gold, we already mentioned, it's finding liquidity providers, and you have a combination there between, the larger banks and the smaller venues and the non-banks. You need to have decent number of them to make sure that you can sustain the market moves like that, because not when the rapid move like the one we witnessed a few weeks ago happens, not all the venues are staying pricing. A lot of them will pull out their price feed, but you still need to fill your clients' orders.
Are you guys all pricing gold and?
No, we don't. Just some of the reasons we alluded to.
It's looks not in your FX business. It's
it's not in the FX business. We're not into commodities, so it's in my previous shop we did do gold for a little bit, and it became very, very expensive. There's various other things around it which become expensive around delivery, as Peter alluded to. So it's not just it looks like it's just a symbol on the screen, but it's not. There's a lot more behind that. So from our perspective, it didn't become it didn't make economic sense, and it's a similar thing for Nomura as well.
So a little bit of shameless advertising, sorry. Gold is actually our second biggest currency pair at Saxo after euro-dollar. And we do have a very good gold price. And again, it's down to long-term relationships.
Do you have a vault?
Real liquidity.
Do you have a gold vault? Or is it in the teeth?
It's all stored in here, yeah. So, no, yeah. But again, it's like many things, the relationships that you have and making sure you have proper LPs that will internalise risk, not recyclers, all that sort of thing, very important in something like gold.
Yeah, just for us as well in Middle East, there's quite a lot of gold, and it's one of our big instruments as well in Middle East, and it's generally big in Middle East, Turkey, Dubai, quite big. So it's an interesting one. Let's go to something else, cryptos, Bitcoin, and that liquidity. It's coming every year, it's getting closer. We don't want to cover it usually on the liquidity panel, but I feel like even Nomura in 5 years maybe, no?
Well, you never know. I think if you look at where, now for me personally, it's a very interesting subject, and that's my personal perspective. You look at it as a product, and I think there are certain things which stop institutional investors going into it. There's recently a survey done by Fidelity looking at digital assets, and high net worth individuals, family offices are really interested. They're either in it or soon to be in it. Hedge funds kind of sit in the middle, but real money's investors, so people who are looking after pension funds and real assets are still very much on the sidelines. Part of that's to do with the regulatory environment. The custodial environment? How do the assets get looked after? You know, there's a lot still to be defined on that on that side. So I think that adoption is still to come. I think as for banks going into space, I think one or two have dipped their toes in. If you look at recently the crypto NDFs that were launched by I think 24 Exchange, I think that could be a space that allows banks to go into, because there's no delivery of assets. So when there's no delivery of assets, you're just trading effectively like a contract for difference, really. And
it's a storage issue for the banks again, right? Almost like gold, but it's maybe even more difficult in terms of hacking. And you guys need to store the cryptos and guarantee that you can provide it to your clients.
Well,
I'm shocked that banks are not doing this.
Well, I think you may see, as you said, over the next year or so, banks entering that space with this crypto NDF. I think you're right in terms of storage. The custody of assets is a problem. We have a joint sort of joint venture with a crypto custodian, and they have had a lot of success because they're an institution, and where one of the problem lies in the crypto space is the storage and the trust that you have to actually have your assets with an exchange who are very lowly capitalized. You really want all your assets and everything with a lowly capitalized entity? Not really. So I think, as I alluded to, there are a few things that need to happen to push it forward into the institutional space, in my opinion. Yeah.
Have you guys entered the cryptos?
We have, not in the delivery space for reason in the same challenges that Ian already outlined. However, you probably see at the floor today a lot of people offering crypto, and it's a crypto derivative. It's a CFD. In terms of the actual physical crypto, there are a lot of challenges. And add to what Ian already outlined is, for example, if you are an FX firm regulated, you're trying to, in your regulated environment, add crypto. There are no specific guidelines in a lot of places yet. And moreover, you actually, in fact, can risk your existing business, your bank relationship, for example, right? Because the banks, run for the hills when they hear that you're going to be accepting crypto. So a lot has to evolve before you are able to do that in a regulated environment. If you look at a lot of the players like crypto exchanges, a lot of them are operating in a different paradigm. There's no reports, there's no regulations. It's difficult for someone who is a regulated brokerage to offer it in the same fashion, because they will have consequences, though I know a lot of people probably launching a separate brand to address that issue, and that seems to be that has been the way to go for many who are trying to enter the space.
So I think we are going in for the crypto CFDs. We've got a fairly wide offering at the minute, and I think it's one of those things where you have to take the next step into physical. But as you said, you have this interesting dynamic where the corporate bank will say, well, if you trade physical, we won't bank you anymore. And then you have the investment bank who are telling you they're setting up a crypto desk. So it's it's a case of eventually these organizations will align. And I think crypto is obviously something that's here to stay. And I think physical crypto is something that we all need to eventually embrace. And I think it will get embraced on the institutional side, but more towards a blockchain, looking at central bank stablecoins than Bitcoin. But it's definitely something that I think all of us here will need to pay more attention to.
I'm surprised that it's not been picked up by the big banks. You can't have a big bank account at a big bank, major bank, HSBC, or one of the big ones, and see your cryptos in your bank account. That's not there, and it's not happening next year either, it looks like.
No, I think cryptocurrencies, there's still an air of grey, a grey area whereby the money gets stolen. Illicit crimes can have payment in cryptocurrency and all the rest of it, which is one of the reasons why the big banks aren't keen on people having physical balances, because it's difficult to check where it's come from. It's all a bit grey. But there is, as the market evolves, there are ways that you can do this in a very regulated fashion. So there's ETNs on the CME, there's futures, there's regulated exchanges where you can trade cryptos as FX pairs, which is what we do. So people can get exposure to cryptos, and they love it because they're volatile, they move around, etc. And that's what people are looking for. So as long as you can get exposure to it in a safe way, where your wallet, if you don't have a wallet, because it could get hacked and suddenly all your money disappears, you know, it's a decent product, and the regulation is evolving over time. But in America, and I think Natallia will probably know more about this, I was reading that the SEC says that cryptocurrencies like Ripple are a security, whereas the CFTC says that cryptocurrencies are a commodity. At the same time, the Treasury says that Bitcoin is a currency. So if the regulators...
I think it's a piece of art.
can't get their head around what these things actually are, I think we've still got some way to go until you know, they're fully accepted and you can get your crypto in your HSBC account. But things are moving. I think you know, are improving all the time, and it would evolve. So,
yeah, and China banned it, right? So we have a few things happening the last month. China banning
absolutely,
it.
but then of course China has exchange controls, and it's sort of a way to navigate you know, and avoid exchange controls. So there's obviously a very interested, you know, interest for them to stop that.
So you guys think basically, pretty much, in 5 years, all of you guys most likely are going to do physical, as in real cryptos, potentially, in 5 years?
I think 100%, yeah.
Yeah,
it's inevitable.
Yeah. Even Ian, 100%?
Don't know about physical. I think everything in life seems to take that bit longer than you think. Yeah. So I'd say probably between 5 and 10 years. A bit like new kitchens, as we were talking about before. So between 5 and 10 years.
But then governments are also launching their own e-currencies. So you're going to have these nationally sponsored cryptocurrencies.
Yeah, they're not decentralized.
Well, no, but you know, it does show that the world's moving on and becoming more acceptable.
I think it'll be a lot shorter than 5 years.
You think it will?
It'll be a lot shorter than 5 years.
One.
Really? Okay, maybe in 2 years then the big banks are giving physical bank accounts to hold your cryptos. Okay, I think anything to add on this one? I think we're pretty much done. We can do some questions, I think, if there are some questions around. I knew Adam would have a question. Question about maybe cryptos, Adam?
Actually, no. I had two questions. Adam Gazzoli from BBUM MOEX. Just the first question was China. How do you view China now as an institution with what's going on with Hong Kong and the regulatory situation out there? You know, is China a big part of your business plans? Some of you have existing businesses there now. I'm just wondering what the plan is going forward with China, or has it become a poison chalice now?
Well, we closed our Asia business, reduced it, but I think China's something that once things change, everyone will go back in somehow. That's how we look at it.
I think things will change. I mean, it's not the first time they do it. It goes in cycles. Like they went through the same cycle in 2008, you know, gain more control and still more regulations. And then, as Hormoz said, people are going to move back in. But obviously, a lot of people who are in FX business took a huge hit on China. I mean, if I come to this expo like 3-4 years ago and I ask them where are they expanding, they will all say China. Obviously, that's not the case anymore. I think it's still there. I mean, there's still business to be done, a lot less, you know, and potentially that's going to change after, you know, the local government there decides on a new chartered course for, you know, overall economy, not just FX related.
I think from our perspective, it's, as Nomura being an Asian entity, we have big presence in China. We do a lot with China. And I think if you look at the sort of interbank FX market, dollar to CNH, so the offshore Chinese currency is one of the biggest, most traded pairs, are very, very important for us too. And we feel it as a real sort of proxy with euro dollar, the way it moves as well. So I think we're there, and I think these controls obviously make things, limit things in somewhat, but then I think, as these guys said, it comes back. It's got to, right? It's one of the takeovers, the biggest economy in the world at some point soon.
Yeah, I think it's important to have a strong presence in Asia, which we do through Singapore, and I think we'll be waiting for China to come back.
You don't need to answer that, Peter. You're Chinese, no? You're owned by China.
Correct.
Right? So you're owned by China, so okay.
So Geely, which is China's largest privately owned car company, the one that owns Volvo, Lotus, etc., is the majority shareholder in Saxo Bank Group. So we do actually have a joint venture in China. We have an office in Shanghai. We market technology, etc., rather than liquidity, obviously, because that's not yet to happen. But the market will change. They will evolve. It's a huge market, enormous market, and with huge potential. So everyone, as long as we're patient and we follow the rules, and one day it will be a huge opportunity for all of us, I'm sure.
Yeah.
Just one quick question, probably more for Ian. On the retail client base in Japan, with the emerging market central banks raising interest rates like Russia, Korea, are you seeing these investors chasing yield, or are they going to head to the US Treasuries, a safer bet?
From what we see, they tend to chase that yield, depending where it is. So it was, be it Turkey yen, Mex yen, Korea yen, a bit more difficult because Korea is a non-deliverable currency, so you have to trade it through an NDF, so it's not as liquid. One of the trade ideas I saw put out on was a Korea yen thing, exactly because of what you just mentioned, a Korea yen digital option, exactly because of the yield in Korea. So yeah, that was more for institutional investors, but retail investors, certainly in Japan, are always chasing yield. So we used to see a heavy amount of Turkey yen, so I would guess they'll gravitate to where that yield is.
Okay. Any other questions? I think we're out of time as well, but great. I think we're done. Thank you very much.
Thank you.
Thank you.
Thank you.